Good morning. How triple net leases really work. And commercial real estate investors frequently pursue properties with triple net or NNN leases because they offer predictable income, lower landlord responsibilities, and long term tenant stability. But despite their popularity, many investors and business owners misunderstand how triple net leases actually work. So, understanding the mechanics of a triple net lease can help investors evaluate risk, analyze returns, and structure smarter commercial real estate investments. So, what is a triple net lease or an NNN lease? Well, a triple net lease, commonly referred to as NNN, is a commercial lease structure where the tenant pays most or all of the property's operating expenses in addition to their base rent. So the three common nets that triple net refers to is for property taxes, for the building insurance, and for the maintenance. So CAM, common area maintenance. And instead of the landlord covering these expenses, the tenant reimburses or directly pays them, significantly reducing the landlord's operating cost and management responsibilities. And this structure is one of the reasons net lease investments are popular among passive commercial real estate investors. So let's talk about how triple net leases work in practice. And a typical triple net lease includes three main payment components. First, you have your base rent. So the tenant's going to pay an agreed base rental rate per square foot. So let's give you an example. Say it's $25 per square foot for base rent. And then you have your triple net expenses. So basically the building's operating costs. And the tenants also pay their share of the property taxes, the property insurance, the building maintenance, the landscaping, the parking lot maintenance, and property management fees in some cases. Snow removal in colder markets, but in Houston, not likely to happen. But these are usually billed as additional rent, is the point. So let's take that example a little further. Say you have a base rent of 25 per square foot and triple net expenses about 8 per square foot. So together you're paying about $33 per square foot. Then you could potentially have annual rent escalations. So most triple net leases will include annual rent increases, typically in the 2 to 3% per year, or fixed dollar increases or CPI based adjustments. And those escalations help landlords protect their purchasing power against inflation. That's why it's done. So, why investors love triple net properties? Well, triple net investments have become a cornerstone strategy for many commercial real estate portfolios. And why? Well, they offer predictable cash flow that's inflation adjusted. And because tenants cover the operating expenses, the landlord receives more predictable income streams with lower management requirements. And triple net properties are often described as mailbox money investments because management responsibilities are minimal. So tenants frequently handle their own maintenance and operational expenses if they're going to be expected to pay them. So that's one advantage there. But typically they're structured with longer lease terms. So many triple net properties have long-term leases, often ranging from 10 to 15 to 20 years. And longer leases create stable income and financing predictability. And you also don't have to worry about finding a new tenant very often. And that just gives you more stability in the property. And triple net properties often include national tenants such as pharmacies or grocery stores or restaurants or banks or automotive service providers. And having stronger tenant credit typically means lower investment for risk as you as the landlord. So some risks that investors should understand before approaching or diving deeper. And despite the advantages, triple net investments are not always risk free. And smart investors always evaluate several key factors. And the first is tenant credit risk. So if the tenant fails, then the landlord may suddenly inherit operating expenses, property taxes, an insurance bill, and some vacancy risk for a building that needs to be filled back up. And tenant financial strength matters, is the point. Lease structures matter as well. And some triple net leases still include landlord responsibilities. And those are often for critical items like, say, a roof replacement or structural building components or parking lot resurfacing. And it's important to always review the actual lease language because that's where it's all spelled out. Let's talk about location. It still drives value. And even strong tenants struggle in weak locations. So investors should always analyze traffic patterns in the area, but also population growth trends and nearby retail synergy and demographic trends. So let's talk about why triple net leases are popular in Houston CRE. In markets like Houston, Katy, and Fulshear have seen strong demand for triple net investments because of population growth, because of expanding retail corridors, and because of strong consumer spending, but also corporate relocation trends. And these factors support long-term tenant demand and stable occupancy. Now, for many investors, triple net retail and service properties provide a balance of stability and income. So here's some final thoughts for the day. And triple net leases are one of the most widely used structures in commercial real estate, and for good reason. What they do is they allow investors to reduce their operating complexity, but also to stabilize their income stream and the ability to hold long-term assets with less management. However, successful triple net investing requires careful evaluation of tenant credit, lease structure, and location fundamentals. And for investors looking to build reliable income through commercial real estate, understanding how triple net leases really work is essential. That, my friends, is it for the day. Please visit HoustonRealEstateBrokerage.com to figure out how to get a hold of me. I'd love to talk to you more. Take care.